Hello everyone, let's get going with our March webinar on the topic of IR35, an overview, and implications for HR. I'd like to welcome all of you listening and watching today. Thank you for joining us. My name is Abby and I am a HR consultant for HR Solutions and shall be the lead presenter today. I'm joined by our Operations Manager Sue in the background. And I'm also joined by Ateem Arden, our Digital Marketing Executive. She will be recording the session and it will be added to our website and HR knowledge base, so you can view it again at your convenience. The webinar slides will be made available on request. So let's have a look at what we'll be covering today. IR35 overview for you, showing what rules apply, the importance of employment status, what responsibilities you may have as a company, how to prepare for April the 6th, working through an intermediary, looking at the potential impacts and next steps, and finishing off with 2 case studies. It's good to start out by thinking about what we are trying to achieve today, and by the end of this webinar, you will hopefully feel that we have met the 2 main aims on the screen now, supporting you to understand the impact of IR35 rules on the private sector and providing some case studies to see how these rules work in practice. So let's get into the subject matter. From 6th of April 2020, changes to tax legislation regulating off-payroll working, commonly known as IR35, will come into effect. The Finance Act 2017 will introduce the new IR35 rules to the private sector, under which contractors working through their own companies must be taxed at source if they would have been employees if engaged directly. The off-payroll working rules can apply if a worker provides their services through an intermediary. An intermediary will usually be the worker's own personal service company, or PSC. They could also be a partnership, a managed service company, or an individual. You may have seen some celebrities in the press, such as Eamon Holmes and Lorraine Kelly, on this very subject. Holmes, who was defeated by HMRC in his appeal against HMRC's tax assessment concerning engagements between his limited company and ITV, and Kelly, who won her appeal at tax tribunal. Note, we're talking about tax tribunal and not employment tribunal, which is a key difference. The rules make sure that workers who would have been an employee if they were providing their services directly to the client pay broadly the same tax and national insurance contributions as employees. So these are the rules that are known as IR35. From the 6th of April next month then, all medium and large private sector organisations will be responsible for deciding the status of these workers and if the off-payroll rules apply. For those working in small companies in the private sector, the rules will remain as they are now, where the worker's intermediary is responsible in deciding the employment status and whether the IR35 rules apply. Off-payroll working rules were introduced in 2000. It was designed to identify those who work like an employee, but through their own company, to ensure they pay similar tax and national insurance as other employees. However, as this was down to the individual to determine their own status, non-compliance has resulted in a deficit, depriving the government of vital funds. Following a reform in 2017, the legislation was extended to the public sector to ensure that tax and NI was deducted at source. Following this reform, it was estimated the government raised 550 million in the first year. The government has marketed this legislation as a way to tackle tax avoidance and ensure a fairness in tax treatment. There is an underlying financial motive in terms of creating a more regular cash flow of taxes instead of balancing tax self-assessments once a year. So let's be absolutely clear who these off-payroll rules apply to, as you may be a small employer that still won't come under the radar. Determining the size of the organisation and therefore whether they have responsibility to decide whether IR35 applies will be if the company meets two or more of the following: annual turnover of more than 10.2 million, a balance sheet total of more than 5.1 million, and more than 50 employees. Therefore, this will not apply to the smallest 1.5 million organisations in the UK. However, for associated companies, if the parent company of a group is classed as a medium or large organisation as above, then their subsidiaries will also have to apply the IR35 rules. There is also a simplified test where the rules apply if an organisation's annual turnover is more than 10.2 million and is not a company, a limited liability partnership, an unregistered company, or an overseas company. If using the simplified test, the rules apply from the start of the tax year following the end of the calendar year when the company meets the above conditions. People have questioned, what if they don't meet the criteria now but do in the future? Well, if a company does not meet the conditions on 6th of April next month, but then are subsequently met for 2 consecutive years, then the date the rules are applied from is the start of the tax year following the end of the filing period for the second financial year when they do meet the conditions. Moving on to employment status, it is important to recognise that the matter of employment status for tax purposes does not determine the employment status for employment law purposes, for example, if ever challenged in an employment tribunal. Therefore, if a worker comes under the IR35 rules, they will not automatically become an employee and be entitled to all employment rights. These rules are designed to identify those workers who are disguised employees in organisations. Those workers as genuine self-employed would not be affected by these rules. Many of you will have used the gov.uk tool to check the employment status of an individual who provides a service for your company, who is a consultant, a contractor, for example. And when this government tool was first introduced, it faced criticism based on its lack of accuracy. The question of employment status is notoriously difficult to determine within employment tribunals, as shown by case law that has found on either side. Each case is very much determined by its own facts. Therefore, it is questioned how the matter of status can be decided by an online questionnaire tool. The tool has been reviewed in readiness for next month and states HMRC will stand by the result you get from this tool unless information given is inaccurate or deliberately non-compliant. However, the results of this tool will not be taken into account in an employment tribunal. So what if there is a disagreement about the status that is determined by this tool? HMRC guidelines state the client must consider reasons for the disagreement and decide whether to uphold or change the determination. The client must provide a response within 45 days of receiving notification of the disagreement. During this timescale, the client must continue with the rules of the original determination. Failure to respond in 45 days means the responsibility for tax and NI will become the client's responsibility. And I'll define what I mean by client on my next slide in case you're not sure. Thorough records must be kept of the whole process. So moving on to responsibilities of the company. The client means the end user company who takes on the workers and must decide the employment status of the worker. The client must complete this status determination statement, including the reasons and any fees paid of whether IR35 is applied or not, and the reasons for this determination to the worker and the person or organisation they are contracted with. If the worker is taken on through an agency, the agency must make the tax and NI deductions, even though responsibility for determining this lies with the client. If IR35 is found to apply, the client or agency must deduct and pay tax and NI contributions to HMRC as follows. They must work out the value of the payment, deduct VAT, and then deduct direct costs of materials for the engagement. They must also deduct expenses that would have been deductible from taxable earnings of an employee. They must calculate employment taxes and NI for the contract, then deduct the taxes and NI from payment to the worker's intermediary, pay employer NICs, report these payments to HMRC through real-time information submission, indicating clearly it is an off-payroll worker. Further responsibilities, the client is deemed as being responsible for the worker's tax and NI until they inform the worker and the person contracted, for example the agency or PSC, with their determination and the reasons for it. The client is not responsible for deductions of student loans, holiday pay, statutory payments such as sick pay, parental pay, or auto-enrolment for pensions. Statutory payments and auto-enrolment will be dealt with through the intermediary. So what do we recommend preparing for then? Well, it is advisable to look at the current workforce to identify those who are engaged through agencies or other intermediaries, for example, those working through a PSC. Consider where these current arrangements are still working for the business and whether they are required to continue in this way. Determine if IR35 rules apply to these engagements. For example, use the government checklist, which is called Check Employment Status for Tax, or CEST for short, and complete a status determination statement to give the outcome either way. Talk to contractors about the rules and what to expect, and ensure they are aware of this change in legislation and what it means to them and their engagements. Implement processes to determine if these rules apply to future engagements and who is responsible for making the determination for each engagement. Ensure recruitment policies are updated to reflect the new rules from April, and raise awareness of this legislation among managers and anyone involved in the recruitment process to ensure it is taken into account when making resourcing decisions, such as shall we fill this vacancy with a fixed-term employee? Shall we get a self-employed specialist on the case? Provide training to those who will be responsible for making the status determination to ensure they have the knowledge and capacity to make the correct determination. Moving on to potential impact with intermediaries. Usually, freelancers and the self-employed are only taxed on their profits, not their full earnings. People who are employed through a PSC usually pay themselves an income and dividends, therefore taking advantage of the lower dividend tax rate. Therefore, this change to the rules means that they are potentially worse off by up to 25% per year. The extended IR35 rules could lead to these workers increasing their costs to cover the deductions that will be made. It remains to be seen whether this is something companies will accept in order to keep their contractors on, and whether they will absorb the additional cost or pass this on to their customers. Contractors will need to decide whether it is financially worth continuing working in this way, or whether they choose to look elsewhere for work. They may feel disgruntled that they are being forced to pay the same amount of tax and NI as employees, but without any employment benefits, such as holiday, sick pay. They may look to become a permanent employee of an organisation and therefore gain employment benefits. or provide their services to a smaller organisation that doesn't have to account for the contractor's tax and NI. Research has shown that half of contractors have threatened to quit their roles when the reforms begin next month. Following the public sector reform in 2017, huge numbers of self-employed workers were categorised as workers. So let's look to the potential impacts on organisations. Along with the additional administration processes and costs, large organisations may lose their skilled contractors who no longer wish to continue in their engagements at a financial loss. Currently, clients may choose to work with individuals who operate through a PSC for security reasons, such as insurance, and therefore, if they lose these working relationships, they may also lose this security. If IR35 is not found to apply to an engagement, it is advisable to review contracts of engagement in place to ensure they indicate the working relationship is in fact a contract for services rather than employment. Organisations can review the nature, length, pay and benefits, which may include engaging on a project basis with a fixed term end date rather than on an open-ended contract to provide services, allowing and ensuring the contractor works for other organisations, affording flexibility and control to the contractor to decide how and when the work is done, accepting the contractor's right to provide a substitute, ensuring the contractor uses their own equipment, and ensuring there is no mutuality of obligation where the company has to provide work and the contractor accept it, as in the case of employment. Some large organisations have imposed a blanket ban on contractors to avoid IR35 altogether. The organisation may choose to replace their contractors with permanent staff to reduce the risk of ending up on the wrong side of the legislation and therefore liable for non-compliance. This runs the risk of losing talent, but also increasing costs, taking on the additional costs associated with employment too. Finally, I'm going to conclude with two case studies where we have constructed an individual's circumstances, put the details through the government online tool to see what the outcome is. Let's take a look at the first one. So here we have a marketing consultant who works through a PSC providing services to large organisations. They're taken on to work on a rebranding project. The contract for services states that this consultant can provide a substitute, but the client has the final say on whether they are accepted to carry out the work in the consultant's absence. The client cannot move the consultant onto other work other than the agreed project. Both parties agree how the work should be done. The consultant decides her own hours and location of where the work is carried out. The consultant will not have to outlay any initial costs before the work is done and before she's paid. The client is not providing any corporate benefits. They're paid an agreed daily rate. The consultant is asked to manage a small team of 2 assistants, current employees of the client, in the marketing team for the duration of this project. When working and liaising with external companies, the consultant will introduce herself as an independent worker working on behalf of the company. This project does not prevent the consultant from working on similar work for other organisations, but the client has asked the consultant to request permission to do so. The consultant has forfeited ownership rights for any creative work. They have agreed this as a one-off contract for now, with the possibility of extension, and this project will take up the majority of the consultant's working time. So, listening to all of that, would you think that the IR35 off-payroll rules apply? Yes. The result was that this situation deems the consultant to be providing a personal service and so is classed as an employee for tax purposes. The example was a large organisation, so they would be responsible for tax N&I. This is an interesting example as from an IR35 tax point of view, they are classed as an employee for tax purposes. But from an employment point of view, as an HR person viewing that list, we would class the person in the employment terms of a worker, not an employee. So it just goes to show how complicated this matter can be between large and small organisations and between how the IR35 rules classify employment status as compared to how employment status is classified within the field of employment law. On to my second example that was run through the CEST tool. Here we have an engineer who works through his own company providing services to a number of clients. He can provide a substitute to carry out the work if he's not available. He would have to pay that substitute from his company. The client he works for cannot move him onto another task other than the agreed engineering work. The engineer decides how and when the work is done according to his schedule and his availability. The location of work is dictated by the task in hand. He's paid a fixed price for the work he completes. The client he works for does not provide any benefits. He can and does work for others, making up a portfolio of clients for his company. So in that context, would you think that the IR35 rules apply? In this scenario, no. And as you might have imagined, IR35 did not apply in this scenario. In practice, with this result, the organisation would need to review the contract of engagement that was in place to ensure it indicated the working relationship as a contract for services rather than a contract of employment. Well, that concludes the information on IR35 today, and I hope you feel that an overview of the topic was clearly provided, explaining who the rules applied to, highlighting the importance of employment status from a tax perspective, the responsibilities of companies and how they can prepare for next month, the implications of working through an intermediary and the potential impacts and next steps for all involved. I then finished with a couple of scenarios that we ran through the government tool. For those listening and watching who are already clients or subscribers of ours, thank you for joining us again today, and please do contact us in the usual way if you have any follow-up queries. If you aren't with us already but would like to ask a question or are interested in our services, then please do contact us at inquiries@hrsolutions-uk.com. You can also use this email address to request a copy of our slides, and you can watch, listen, forward our webinar recording from today by heading to our main website at www.hrsolutions-uk.com and clicking on resources and then video and webinar archive, or watching straight from our HR knowledge base from the webinar library section. This webinar and all our previous webinars are recorded. We have a huge bank of them now, and these can be found on our website. The link address is on the slide, and I've listed the most recent webinars on your screen to give you a flavour of what we have presented on recently. We added an extra one on Monday of this week on the coronavirus, which, as you can imagine, was very well attended, and you can watch this again at your leisure. Whilst the webinars are relevant to the time that they were recorded, the information that you will watch again are still wholly relevant in terms of legal compliance and practicality. Please sign up for our webinars on the events page on our HR knowledge base. Our upcoming webinar for next month is the Good Work Plan, looking at contractual changes and implementation. Next week, we commence our programme of employment law seminars. These are free to our clients and subscribers and will provide practical guidance on how to protect your business from the risk of employee claims. As a HR Knowledge Base subscriber, you are already signed up to our e-newsletter, which means that you get to hear about our latest webinars and events first, and also keep abreast of any other developments. If you need support, contact us. We're here to help. So all I have left to say is thanks for listening, and I hope you found today's webinar informative. Thank you.